Your backtest looks profitable, your live account doesn't, and the strategy isn't necessarily broken. The problem is that your backtest may be testing a market that doesn't exist in live trading. There are 8 things that can create that gap, and some of them can make a strategy look profitable when it never was. 1. Spread. A backtest often assumes you entered at the displayed price. Live trading has a bid and an ask. You buy at the ask. You sell at the bid. That difference is the spread. If your strategy targets small moves, spread can eat a large part of the expected profit. So test with realistic transaction costs. 2. Slippage. Your backtest might say, entry 1.1050. Live market, you might actually get 1.1052 or worse during fast markets. That's slippage. It gets particularly important around news, market opens, and low liquidity periods. A strategy with tiny expected profits can disappear once realistic slippage is added. 3. Execution delay. Backtests can execute instantly. Humans don't. You see the signal, you decide, you click. The order reaches the market. That delay matters when price is moving quickly. If your edge depends on entering within a few pips, execution is part of the strategy. 4. Bid/ask data can change the result. Here's an easy one to miss. Your chart might show the mid-price or one side of the market, but your actual order interacts with the opposite side. That means a historical candle can appear to never touch your stop, while the actual bid or ask price did. If your backtest doesn't model both sides correctly, your results can be overstated. 5. Look-ahead bias. This one can completely ruin a backtest. You accidentally use information that wasn't available at the time of the trade. For example, a candle closes. Your system uses that completed candle, but your test enters at a price that was only knowable after the close. The result looks perfect. Live trading can't do that. Your backtest must only use information available at that exact moment. 6. Overfitting. You test 100 variations. Different indicators, different stops, different time frames. Eventually, one combination looks incredible. That doesn't prove you found an edge. You may have simply optimized the strategy to historical noise. The real test is whether the logic survives data it has never seen. 7. Sample size. 20 winning trades doesn't prove much. Neither does 50. You need enough trades across different conditions to know whether the result is repeatable. A strategy that looks incredible during one trending period can collapse when volatility changes, which brings us to the biggest problem. 8. Market regime. A strategy doesn't trade a chart. It trades a market environment. Trending markets, range-bound markets, high volatility, low volatility, news-heavy periods, quiet periods. A strategy built around momentum can look amazing during a strong trend, then fall apart when the market starts ranging. The real test, so don't ask, did my backtest make money? Ask, does the edge survive realistic costs, unseen data, and different market conditions? Test with spread, slippage, execution assumptions, correct bid/ask data, no look ahead, out of sample data, large enough samples, multiple market regimes. If it still works after that, now you have something worth investigating. Because the goal of a backtest isn't to prove your strategy works. It's to find out how easily it breaks. And that's the test that actually matters. Subscribe to MarketsVox for more practical forex education without the usual trading hype.